Hello and welcome back to Debit Credit Done. This is the podcast that demystifies accounting one concept at a time. I'm Dean, and in today's episode we're going to explore one of the most important foundations of accounting, the accounting equation. In episode 2 we talked about DEAD CLIC and how we use debits and credits to record transactions. That episode laid the groundwork for understanding how transactions affect different types of accounts. If you've not yet listened to episode 2, I recommend going back and giving it a listen first. Today we build on that by introducing the equation that keeps our entire system balanced. It is a simple but incredibly powerful equation. Assets equal liabilities plus capital. By the end of this episode, you will understand what this equation means, how to use it, and why it underpins every transaction in double entry bookkeeping. So let's start with the basics. The accounting equation states that a business's assets are financed either by borrowing money, which creates liabilities, or through investment from the owner, which is called capital. So if we think of a business as a container, everything inside that container the business owns, such as a van, equipment, inventory, or money in the bank. So these are all assets. But those assets had to come from somewhere. Either the business borrowed money to acquire them, creating a liability, or the owner put money in, which becomes capital. Here is a simple example. If I start a business and put £1,000 into a business bank account, the business now has this bank asset of £1,000. But that £1,000 is also going to be recorded as capital because it came from me, the owner of the business. So looking at the accounting equation, assets, a bank, would be £1,000, and capital, money I've invested, would also be £1,000. So we have a perfectly balanced accounting equation. Now let's say the business also took out a £500 loan. The business would now have £1,500 in assets, the £1,000 I invested, and £500 from a loan. So if we updated the accounting equation, we've got assets £1,500 equals liabilities £500 plus capital £1,000. Still a balanced accounting equation. So every transaction in double entry bookkeeping will affect at least two accounts and must keep that equation in balance. That is the magic of double entry bookkeeping. So let's walk through a few more realistic examples to reinforce this concept. So, example 1. You start a business and invest £2,000 into the business bank account. So what we're going to get then is an asset, the bank, increasing by £2,000. We're also going to get a £2,000 increase to capital. So looking at our accounting equation, assets equal liabilities plus capital, we've got £2,000 of assets, no liabilities, and £2,000 of capital. A balanced equation, £2,000 equals £2,000. Example 2 then, if you buy a laptop for £800 using the business bank account, our bank asset would decrease by £800. But we're also buying an asset, a computer, and that would increase by £800. So the value of assets has not changed. You've simply just swapped one asset for another. Therefore, the accounting equation remains completely balanced. Example 3, you purchase stock worth £1,200 from a supplier, but you haven't yet paid for it. It's on credit. So your asset, inventory, increased by £1,200, and you've got a liability to trade payables, which is also increasing by £1,200. So now you've increased assets and liabilities by the same amount. Yeah. so still perfectly balanced. And that's the beauty of it. Every single transaction affects 2 or more accounts, but the totals on each side of the accounting equation must always match. Let's just take a quick moment then to clarify what capital really means. So capital represents the owner's stake in the business. It is essentially what the owner would get back if the business sold all of its assets and paid off all of its debt. So capital increases when the owner invests more money into the business or the business earns a profit. And capital decreases when the owner withdraws their money, known as drawings, or the business incurs a loss. Now, we will go into more detail about profit, loss, drawings in future episodes. For now, it's just important to understand that capital is not a static concept. It grows or shrinks based on how the business performs and how the owner interacts with it. Profit flows into capital at the end of the accounting period. And again, we'll explore how that works when we look at financial statements in later episodes. So why is this equation so important? Well, firstly, it helps you to analyse transactions properly. If you know what type of account you're dealing with, whether it's an asset, a liability, or capital, you can apply the DEAD CLIC principles from the last episode to decide if it should be debited or credited. Secondly, the accounting equation is a built-in accuracy check. If your accounts do not balance, it tells you you've got something wrong. Perhaps a transaction was missed or recorded in the wrong account. And finally, the accounting equation forms the structure of financial statements. The statement of financial position, also known for the old people amongst us as the balance sheet, is built directly from this equation. By understanding the accounting equation, you are setting yourself up for success as we move on to things like trial balances and financial reporting. So let's recap the key points from today's episode. The accounting equation is simply assets equals liabilities plus capital. It must always balance. Every transaction affects at least 2 accounts. Assets include things like the bank, inventory, equipment. Liabilities are amounts the business owes, usually to people like trade suppliers. Capital is the owner's interest in the business. And this equation is the foundation of all double entry bookkeeping. If you understand it, everything else becomes easier. So that is it for today's episode of Debit Credit Done. I hope the accounting equation now feels like a logical and manageable tool instead of just another formula you need to memorise. So in our next episode, we're going to move on to look at journals, and we will look at how to structure journal entries, what information to include, and how to use them as a starting point for the wider accounting process. Finally, if you found today's episode helpful, please share it with your classmates or colleagues. And do not forget to subscribe on your podcast service of choice so you never miss an episode. You can also leave us a review. That helps more students find what is a free support tool. And until next time, keep balancing your books. And remember this, in accounting, every debit has a credit. And when the equation balances, you're on the right track. Until next time, I'm Dean. This is Debit Credit Done.